Welcome to our CFP Exam Prep podcast. Today, we're diving deep into Section 179 deduction, a crucial tax topic that frequently appears on the CFP exam and is essential for financial planners to master. Let's break down Section 179 deduction into its core components. This tax provision allows businesses to deduct the full purchase price of qualifying equipment and software purchased or financed during the tax year. Instead of capitalizing the asset and depreciating it over several years, businesses can take the entire deduction in the year the asset is placed in service. For 2023, the maximum deduction amount is $1,220,000, and this is where candidates often get confused in practice questions. The deduction begins to phase out dollar for dollar when qualifying property purchases exceed $350,000. This means if a business purchases $3,250,000 in qualifying equipment, their available Section 179 deduction would be reduced by $200,000. Here's a practical example that often shows up in exam questions. Imagine a small manufacturing company purchases $200,000 in new machinery. Since this amount is below the $350,000 threshold, they can deduct the full amount up to $1,220,000 under Section 179. The remaining $780,000 would follow regular depreciation rules. A common mistake test takers make is confusing Section 179 with bonus depreciation. While both allow for immediate expensing, they have different rules and limitations. Section 179 is limited to business income, while bonus depreciation isn't. Also, Section 179 can be applied selectively to different assets, giving businesses more flexibility in tax planning. Another tricky area is understanding what qualifies for Section 179. The property must be tangible personal property used in business more than 50% of the time. This includes machinery, equipment, vehicles over 6,000 pounds, computers, office furniture, and off-the-shelf software. Land and buildings generally don't qualify, though certain improvements to commercial buildings do. When tackling exam questions about Section 179, watch out for these test traps. First, candidates often forget to check if the business has sufficient income to take the full deduction. Section 179 is limited to the business's taxable income. Second, they miss the phase-out calculation when equipment purchases exceed the threshold. Third, they fail to recognize that the deduction must be reduced for any personal use of the asset. Here's a quick way to remember the key numbers. Think of it as the 1 to 3 rule. The deduction limit is approximately $1.2 million, and the phase-out begins at about $3 million. The exact numbers change annually for inflation, but this rough approximation will help you identify obviously incorrect answers. For your exam preparation, focus on understanding how to calculate the available deduction when purchases exceed the phase-out threshold. Also, practice identifying qualifying versus non-qualifying property, as these concepts are frequently tested. Remember that Section 179 is an election, meaning businesses can choose whether and how much to apply to each eligible asset. Understanding Section 179 is crucial not just for the exam, but for real-world application in financial planning. It's a powerful tool for tax planning and business advisory services that can significantly impact a business's cash flow and tax liability. Keep these points in mind as you prepare for your CFP exam, and you'll be well equipped to handle questions about Section 179 deduction. Good luck with your studies.